The noise from Washington to regulate Facebook and Amazon just keeps getting louder, leaving many investors concerned for the future of big tech and wondering how they should play a potential breakup of these tech giants. That's the question we're looking into today as part of our week-long series, The Breakup. Kim Forrest, Chief Investment Officer at Bokeh Capital, and Laura Martin, Managing Director at Needham & Company, join us now to discuss what investors' next move should be. Kim, I want to start with you a little bit here. What do you think these companies should do? Can they be broken up? Should they be broken up? What are some of your thoughts?
I really am suspicious of the whole breakup idea, because if you look at the history of trying to break up tech companies, it doesn't look that good. Microsoft's probably the great poster boy for that. And even though they were told they were going to break up the company, it actually did not happen. And I think that suited the investors well. We can debate about whether their customers were served well, but it is a remote chance for that to happen, I think.
Laura, you believe not all the FANGs are going to survive this battle, and you say the fact that the FTC now has jurisdiction over Facebook and Amazon actually weakens their investment positions versus Apple and Google, where the jurisdiction there is with the Department of Justice. Explain that to us.
Sure. So I love the idea of breaking up these FANGs. For one thing, Google, I think, would be more well-run and certainly have more disclosure if you broke it up into 4 or 5 pieces. I do think that because Apple and Google are now under the jurisdiction of the DOJ, they tend to look at court types of solutions like breakups, whereas the FTC is an open process, and therefore Facebook and Amazon are going to get dragged through the mud with hearings. And those are consumer-facing companies. So the FTC historically has not gone through the breakup process. So I don't expect them to break it up. I just expect them to hurt the consumer-facing businesses and the brand value of Facebook and Amazon, whereas I would love to see Google broken up. I think it adds 50% of value to break up Google, actually, because Wall Street loves pure plays. We vastly prefer to invest in pure plays than a big conglomerate of lots of different risk profiles.
Laura, you actually say Google is worth 50% more broken up, really?
I do. Yep, I do. I think it'd be run better. I think the disclosure would be better. And I think we would love to have a pure play of Waymo and a pure play of YouTube and a pure play of the search engine and a pure play of the ad network. They're all different businesses. They have different risk profiles and therefore different investor bases that today can't play.
Kim, how are you trading some of these names? When you hear what Laura just said about Google potentially worth 50% more if they're broken up, does that get you excited and you want to put on that trade?
It does, and I've never liked Google as it has become for the exact same reasons Laura outlined, the lack of transparency and the fact that they've shoveled a whole bunch of money into some kind of some crazy ideas. You know, I don't know if anybody remembers Project Loon, where they were going to put balloons up in the air to make Wi-Fi. Stuff like that just drives me crazy as an investor. So I do like more transparency.
Laura, getting to your rating on Facebook, you rate Facebook a hold. At one point, do you just move to a sell?
So it's up to the government. I mean, I like this. It's been moving up on this cryptocurrency. The thing about Facebook is it's really well run. So their brand is getting damaged by the FTC, but this is a really well run company. So you don't get the advantages of better execution if you break it up into pieces. And I just don't think that's the FTC's playbook. But I do think that you're going to continue to see governmental scrutiny on privacy. Look, I think there's a big open question as to whether the scrutiny on privacy by both the EU and the US makes advertising revenue less attractive as a monetization source for every company run by digital advertising world. I think that's a big question here.
A last question to each of you, if you could weigh in on this. And Kim, I'll start with you. If you have these stocks in your portfolio right now, and many of us do, whether it's a mutual fund, 401k, or what have you, and as you see this play out in the government, especially in the run-up to the 2020 election, what do you do with these stocks in your portfolio right now?
I think you take a really good look at them and say who is likely to grow. Even in a highly regulated area, you keep those and you jettison the rest. Wall Street rewards growth, and especially in momentum stocks, which these are, they have to grow. So if they're given some kind of limiting factor like onerous regulation that's going to eviscerate their ability to grow, Don't own them. I don't care what they did in the past. Walk away.
All right, Laura, what's your take?
Apple, buy Apple. 14 times earnings. You know, Netflix trades at like 15 times revenue practically. Okay, it trades at 10 times revenue. But the point is, Apple, great business profile, great earnings momentum. It's getting revalued as a subscription business instead of a units business, which I think is the right way to value Apple because I think it's an ecosystem with very low churn and has a monopoly on mobile devices for the richest 15% of the world. So I would buy Apple.